Hi everyone, Adrian Player here. In this video we're going to be talking about inflation. Now I was participating on a Facebook group recently, a property group, and there was a guy that was late 50s and he had a very staunch views on economics, especially due to him being a little bit older, seeing things in the market in the past and then applying those same principles to the current market, not understanding the current economics and what's actually happening in the current economy. So he replied very basic, and I'll be honest with you, at the end he said Economics 101, which piqued my interest a little bit. As soon as I saw that, I thought there was a little bit of a challenge there. So I thought I'd get a little bit more data together and give him a response, which I don't think he liked too much. He thought I was trying to school him. But really I gave him a number of different sources and reasoning, and I'll give you one example. I said to him on one of the replies that I gave him, because he thought the interest rates were going to go back up and stay up. And I said, well, go on to the RBA interest rate levels since, say, the 1980s, so the late 1980s, when we peaked at over, say, 18 to 20% interest rates. Draw a trend line from then till now and show me any time in the last 40 to 45 years that interest rates have gone up and stayed up. Now that's just a very basic understanding on where this is going. Other things that I talked about in my reply to him, which isn't in this post, was you need to understand the property market cycle and the stock market cycle, and a good guy to look at is Phil Anderson. So he's an analyst, a data-driven analyst that has done a lot of data, a lot of back-end history work, and he's presented papers, he's done books, and he's got an analyst website as well where he publishes economic data with a number of other analysts. So Phil Anderson is one of the other ones that I would suggest that you go and have a look at. And really, the guy that I was talking to in his late 50s was saying interest rates will go up, disposable income will go down, which means that over the next short-term period of time, which could be 1, 2, 3, 4, 5 years, I don't know, I didn't ask him directly what his time frame was with his analysis, but he said that this isn't going to look good for property when everything that I've researched and everything that I know says that it's the exact opposite. This is going to be one of the biggest boom times in property in the next, say, 5 to 7 years, right up until the end of 2026. So let's go into my post reply, and then just let's talk about it a little bit. So my response, so we're starting from here. I would counter you on these items. Item 1. The last time we had a similar scenario to this was the 1970s, which led to the interest rate crisis of the late 1980s, 15 to 20% interest rates. At that time, the mortgage size was, for example, 40 to 60,000 in areas like Canberra. And at the time, banks had mechanisms in place where you needed much larger deposits of 25 to 35% for most loans. Okay. Now, average household debt in the city market in Australia is about 700,000 to 800,000 on average. Okay, with the average price in the city market of 1 to 1.1 million. Okay, now in the city market you do have 6 to 8 million people at any one stage in the city market, which equates to about a third of the total population of Australia is in Sydney at any one time. Okay, with debt to income ratios of 6 to 8. So when you had a look at that Canberra example that I gave above, the average incomes were about, say, 2 to 2.5 of whatever the mortgage was. So standard middle management incomes back then were anywhere between about, say, high teens, so 18,000, up to the high 20s, so maybe 28,000, depending on how high you're getting in management. But 80s, 90s, and early 2000s, there were a lot more middle management jobs that were paying very well. Okay, so the debt to income ratios are now not 2 to 2.5, they are 6 to 8. on average, okay? And we know that because ASIC and APRA have come into the market and limited some lenders to 6 debt-to-income ratio. And it's very easy to figure out what that is. So if you're earning $100,000 total, including your wage and any rent that's coming in, then a debt-to-income ratio of 6 would mean that you've got a loan size of $600,000 currently against yourself. All right, so the next one that we'll look at is the same interest rate mechanisms of a 10% rise in the interest rates in the 1980s isn't possible now. You could raise rates even 2% and it would bankrupt and put a hell of a lot of mortgages in default right now. So a 2% increase right now is the equivalent to over a 10% rise in interest rates in the 1980s, mainly due to the wage deflation, mainly due to the increases in prices in property and the massive debt-to-income ratios that we now see in the Australian market. All right, so the next paragraph. So wage stagnation has been occurring for 20 plus years, and there is a new phenomena of wage deflation, i.e. all those COVID people accepting 20% wage reductions while COVID was going, and their incomes have now not gotten back to where they were 2 years ago. So you had all these people that were afraid of losing their jobs and company management coming to them saying, well, if you all reduce your incomes to a certain level, we'll keep you on. There's actually a phenomena that's happening at the moment where a lot of those wages aren't going back up. So it's actually wage deflation. All right, now we've also seen, I'll give you an example, the middle management, they were on good income. So I'll give you an example. My father was a middle manager, working a lot of hours, but the company paid well. He got to middle management in, say, the early 2000s and was on over 100,000 income, maybe up to 120,000. Okay, that same job right now may pay a little bit more, maybe 130, 140 maximum. Okay, 90% of those roles were cut. Okay, and the responsibility of that level now means that they would have, say, 15 to 20 direct reports now, and the income's only gone up 10 to 20 grand. So there's been a massive amount of wage stagnation in the Australian market as far as professional jobs go, especially in those middle management areas. And not just that, wages stay the same, but property prices keep on going up. So then you're in situations where you need double incomes to buy these properties over $1 million. So that's that. And then the next one is, so in a nutshell, I'm saying the RBA has no ability to control this. And even worse, the government will have to have huge reductions in public purse spending and welfare to reduce the money supply and control inflation, plus couple restrictions on borrowing power to even have a chance of stopping this runaway train. All right, so that's the first response that I gave. That's a little bit of context in how I discussed it. And then we'll just scroll down to the next one. So on item 2, I said I would also counter that banks stress testing the borrowing at 3% above what the interest rate the customer gets is very different on a risk level to it actually happening in real life. So in real life, the majority set their living standards to their income. So if their income goes up, so does their expenses. So even a 1 or 2% adjustment to the interest rate will crush a lot of people, which is only half of what the banks stress test the borrowing power at. It's human nature. So I'm a mortgage broker. I see it every day. People have increases in their income, or a joint income, or the household income goes up significantly, and so does the living expenses. They go out, they get the 2 SUVs on car finance. They go out, they start having more dinners. They go out, they have the big holiday per year. Okay, they go out on 200 grand income and spend 1.5 million total in the Australian market in southern Sydney where I am. And you know, they've got a mortgage of say 1.2, 1.3 million on 200 grand a year household income. Look, I see this daily, and it's human nature that they max out their borrowing power. So I see it every day. I have first home buyers and people that want to purchase. They go out into the market after they get a pre-approval, and they come back 1, 2 or 3 times, and they continue to ask for more borrowing power, okay, until they're completely maxed out. All right, so it's just human nature. They max themselves out from a lender point of view, and then they go into their household environment, and then they max themselves out there. So even a 1 or 2% adjustment on that interest rate over a short period of time could crush a lot of those people. So this is just a good idea on, you know, what's happening in the current environment, you know, what's happened in the past, and how we're on a very different trajectory. I mean, if you have a look at the trend line for the 1980s to now, as far as interest rates go, then the only thing that you can really extrapolate from that data is that we're in a position where inflation is not going to be fully controlled, and interest rates are in an environment where in 5 years we could be in negative interest rates. Sure, we're going through a little bit of a blip now. Over the next kind of 12 to 18 months, there might be a couple of rises, 3 or 4 rises. But how long do you think that's going to last? Okay, we're in a situation where half of the businesses have been shut down during COVID-19. You know, all these people have been bankrupted. All this money has been spent. Money has been printed. In America, I think they've gone up to over 5 times the total money supply has been printed in the last kind of 10 years. Okay, you can't have huge things happen like that and not have huge impacts to economies and to currencies. And let's be honest, if you go onto YouTube and you go through documentaries, there's actually a couple of really good documentaries on there that talk about the rise and fall of currencies and countries. So countries, you know, like the Mongols or the Chinese or the Europeans or the UK or the feudal era or the Stone Age, like all these different periods of time where inflation has crept into an economy and then caused the rise or fall of that economy or currency. Okay, normally it hits the currency first, then they can't control it, then the economy goes down, and then a new power rises up. All right, so I love that. I go onto YouTube, I look at it. I mean, there's a famous period of time where the Mongols, one of the brothers, took over the Chinese dynasty. And then after that, they had huge amounts of inflation after that, which they couldn't control, which caused a really big issue during the 15, 16, and 1700s in the China economies. Okay, while they were trying to fight away the Mongols and a number of other powers at that time. So really, this isn't a new phenomena. We just think in the current environment that, you know, America is indestructible, so is Australia. We don't have long-term aspects when we look at, you know, how long a currency should last. How do you control that currency, and how do you control an economy during those times? But in reality, if you have the current form of the dollar, it's been around for about, say, 60 years. You don't have many currencies that last, you know, more than 100 years total at any one time without huge changes to how that currency is benchmarked or what new currency comes up. So, you know, this is just talking about that in a nutshell, talking about, you know, as far as I'm concerned, the market's going to go nuts. We're going to see huge amounts of property appreciation in the next kind of 5 years. I see a huge boom period of time over the next 5 years. I mean, we have a phenomena in Australia where 90% of the people want to live on 15% of the land. And not just that, the majority of those people want to live on the eastern seaboard. Okay, so we're pretty much the only country on the planet that phenomena is here. All right. So, we're in a situation where there's a short supply of land. Everyone wants to live close to a capital city. There's only 3 capital cities on the eastern side. All right. And yeah, there's a lot of house and land packages going around and things like that. But land is becoming scarce, and we haven't even opened up the borders to after COVID has happened. So as soon as that happens, we're going to have periods of boom periods of people coming into this country that have been locked out for the last 2 years. Okay, we're going to see huge amounts of inflation coming into the country. We're at 6 to 7% in America. Most likely, we normally act on a 6 to 12 month delayed fuse, so we follow whatever happens in America normally. And then you're going to have the phenomena that's going to happen over the next 10 years, where all the baby boomers, the biggest wealth generation in the country, are going to start retiring over the next 10 years. And as they retire all of their assets, they'll start paying less taxes. Okay, and then what's going to happen is, if all of these taxpayers with all this money exit the economy and don't pay as much tax because they reduce their living standards and they go into retirement mode, then what do you think the government's going to do? They're going to triple the amount of people coming into this country. So we're going to go from 300,000 per year to 4 times that, 1.2 million people a year. The 517 visas are going to go from a couple of 100,000 issued a year to 500,000, a million, 1.5 million. All right, so we're going through a really big reset in the economy at the moment, and if this is just let's be completely honest. We have accountants, we have financial planners, okay, we have people that can give us advice. All right, I'm not one of those people, but I am an investor that is putting my money where my mouth is. Okay, I see this as an incredible time to build wealth. All right, so always going back to you speaking with qualified people. I'm just a mortgage broker, personal investor, and this is my view on the market. All right, so before you make any big changes to your investment style, or if you will or will not invest, or where you will invest, I'm just a guy here that's talking about my personal view. I'm giving a lot of data behind those views, and you can take it or leave it, but hopefully this is adding a lot of value to your perspective on the market. All right, I'm not just showing you those views. You know that I'm a personal investor. I've got 4 investment properties, and by the end of this year I'll have 6, 7 or 8 investment properties this year, and I'll continue buying into 2023 as well. All right, so I hope this video has helped you talk about inflation, talk about the dynamics on what's happening in the Australian economy, and really just give you a personal view of what I think is happening, and I'm acting on that as well. All right, so I do a lot of wide reading. I listen to a lot of different sources. I go onto YouTube. I look at different analysts. Okay, and I love every time the big banks start coming out saying that there's going to be a huge crash, like all the big banks did in COVID-19 in 2020. And then it saw the biggest boom in the property market that we've seen in the last 10 to 15 years, and the banks were all wrong. All right, so I hope you've enjoyed this video, and we'll see you on the next one. All right, bye.